Most investors still rely on the classic 60-40 portfolio, 60% stocks and 40% bonds. But in 2026, that model is under pressure because bonds are no longer consistently providing the diversification they once did. Historically, stocks and bonds often moved in opposite directions, making bonds a natural hedge. However, since the inflation surge of 2021 and 2022, stock-bond correlations have frequently turned positive, meaning both asset classes have declined together. In 2022, for example, the S&P 500 fell about 18%, while the Bloomberg U.S. Aggregate Bond Index dropped roughly 13%, marking one of the worst combined drawdowns in decades. As a result, many investors have begun looking beyond traditional portfolio construction and toward real assets. Real assets are investments tied to physical assets or real-world demand, including commodities, gold, real estate, REITs, and infrastructure. Unlike stocks and bonds, their performance is often driven by inflation, supply constraints, and economic demand cycles. This makes them especially relevant in an environment where inflation remains uncertain and market conditions continue to evolve. One of the biggest advantages of real assets is diversification. Because their return drivers differ from those of stocks and bonds, they can help reduce portfolio concentration risk. Gold has historically shown low correlation with equities. While commodities often move independently of traditional financial assets, this can provide valuable balance when stocks and bonds struggle at the same time. Real assets can also help protect against inflation. Commodity prices often rise as input costs increase, energy markets react quickly to supply disruptions, and real estate and infrastructure assets may benefit from pricing power over time. Energy markets react quickly to supply disruptions, and real estate and infrastructure assets may benefit from pricing power over time. During the inflation shock of 2022, broad commodity indexes gained roughly 20% to 25%, while energy was among the strongest performing sectors globally. Historically, gold has also preserved purchasing power during periods of elevated inflation. From a portfolio construction perspective, real assets can improve diversification and enhance inflation-adjusted returns in certain market environments. This is why many institutional investors allocate between 5% and 15% of their portfolios to real assets. Most individual investors gain exposure through ETFs, including gold ETFs, commodity ETFs, REIT ETFs, and infrastructure ETFs. These vehicles provide diversification, liquidity, transparency, and relatively low cost without the challenges of owning physical assets directly. Many portfolio frameworks today suggest allocating roughly 5% to 10% to real assets. The goal is not to replace the traditional 60-40 portfolio, but to strengthen it for a market environment where stocks and bonds may not always provide reliable diversification. Of course, real assets are not risk-free. Commodities can be volatile, they may underperform during strong equity bull markets, and they remain sensitive to economic cycles, policy changes, and global demand. Their role is not simply to maximize returns, but to improve portfolio resilience across different market conditions. The key takeaway is simple. Real assets matter because the investment landscape has changed. They can provide diversification when stocks and bonds move together, offer some protection against inflation, and create exposure to real-world demand cycles. They are not replacements for traditional assets, they are complements. Because in 2026, the strongest portfolios aren't built on stocks and bonds alone. They're built on how effectively they connect to the real world.